Buyers are back. That is what they are telling you right now. Gold bounced. It clawed back the ground it had given up and pushed a little higher. And all at once, every headline is singing the same tune. The buyers have returned, and they are not done. Here is the problem with that. A bounce is the easiest thing in the world to fake. If you own gold right now, or you have been sitting on the fence thinking about it, this is the exact moment you are most likely to be fooled. Because a couple of green days feel like proof. They feel like permission. And the people who want you to chase it, and the people who want you to sell into it, both know that a bounce short circuits the one question that actually matters, which is not how much did it move, it is who moved it. So here is what I'm going to give you. By the end of this, you will be able to look at any bounce in this metal, this one or the next one, and tell the difference between real buyers coming back and a hollow little rally dressed up to look like them. And the tell has almost nothing to do with the number on your screen. There is one buyer that decides this. Not the day traders, not the hedge funds flipping futures before lunch. One buyer, the biggest one in the entire market. And whether that buyer is in or out is the whole ballgame. I am going to save exactly who it is and why it never actually left for the last few minutes of this, because it is the part the financial channels will dance around and never say plainly to you. Stay with me and you will have it. And to understand who really moves this market, and why a government's need can quietly override everything you think you know about supply and demand, I have to take you back to a piece of American history that almost nobody remembers, and that the people managing your money would very much prefer you never think about. Go back with me to the years right after the Second World War. Picture an ordinary American saver. Call him a returning veteran, a man who did everything his country told him was right. All through the war, he had bought the bonds. War bonds. The poster on the wall, the patriotic duty, the safe and sound way to store the money he earned. He put a real chunk of everything he had into the debt of the United States government because he was told, correctly, that it was the safest paper in the world. And it was safe, in the sense that it never defaulted. He got back every dollar he was promised. Here is what he was not told. Behind the scenes, from the war years right through into the early 1950s, the Federal Reserve was not a free agent. It had made a deal. To help the Treasury finance that enormous war debt cheaply, the Fed had agreed to pin interest rates down, to cap the yield on government bonds and hold it there, buying whatever it had to buy to keep those rates from rising. For roughly a decade, the central bank was not fighting inflation. It was serving the Treasury. It had one job, and that job was to make sure the government could borrow cheap. Now, think about what that did to our saver. Prices after the war did not sit still. Inflation came in waves, and at times it ran hot, well into the double digits. But the yield on his safe government bond was pinned down by design, held below the rate at which his own cost of living was climbing. Every year he collected his little bit of interest and felt responsible. And every year, quietly, the purchasing power of that bond shrank because the state had decided that its own need to finance itself came before the value of his savings. He was not robbed in any way he could see. There was no crash, no headline. He held the safest paper on earth, and it hollowed him out from the inside for 10 years, and he never fully understood why. That arrangement has a name. In 1951, it was formally ended in something called the Treasury-Fed Accord, the moment the central bank fought to win back its independence. But do not let the tidy ending fool you. For 10 years, in the United States of America, the government pinned a market to finance itself, and the people holding the paper paid the bill. Economists have a cold phrase for it. They call it fiscal dominance. It means that when a government's need to fund itself gets big enough, that need starts to override everything else. The market, the savers, the rules you thought were fixed. And I am telling you this old story because it is not old at all. It is the single most useful lens you have for understanding who is really buying gold right now and why. Because here is the question you actually clicked on. Are the buyers truly back, and are they truly not done? And the only honest way to answer it is to stop staring at the bounce and start asking who is doing the buying. Let me give you the case against, honestly, because you deserve the strong version and not some straw man I can knock over. A skeptic looks at this bounce and says, fine, gold recovered the ground it lost and poked out to a multi-week high. So what? A few good days prove nothing. The Federal Reserve under Kevin Warsh has turned hawkish, and Warsh is not shy about it. He is telling anyone who will listen that prices are still too high, that a rate hike is more likely than a cut, and gold pays you no interest. When the man running the central bank is threatening to make cash and bonds pay more, the whole reason to hold a metal that yields nothing gets harder to defend, not easier. So the skeptic says this bounce is a trap. It is short covering. It is tourists who bought the dip and will be gone by the next scary headline. The buyers are not back. The buyers are a mirage, and the Fed can crush this thing again any morning it feels like it. And I want to be straight with you. That case is not stupid. Every piece of it is true. The Fed is hawkish. A hike is genuinely on the table. Gold really did just get shaken, and it really can get shaken again just as fast. If you are holding, you have felt it, and anyone who tells you the down days cannot come back is lying to you. But that entire skeptical case has a hole in the middle of it, and the hole is exactly the thing our war bond saver learned the hard way. The skeptic is watching the traders. He is watching the funds, the tourists, the fast money that came and went. He is asking whether the fickle buyers are back, and he is completely ignoring the one buyer that was never fickle and never left, the official sector, central banks, governments themselves. Because here's what has actually been happening underneath the bounce, quietly, for years, with no drama and no headline. The central banks of the world have been buying gold at a record pace, not trading it, buying it and putting it away as a matter of policy at a rate this era has never seen before. They were buying while the price was high, they kept buying while the price got shaken down, they did not flinch when the tourists ran, and they did not celebrate when the bounce came. They just kept accumulating, because they are not in this for a trade. They are in it for the very same reason the Fed pinned those bond yields in 1951. A government under strain reaches for what it can control and what it can trust, and increasingly, what it trusts is gold it can hold in its own vault, rather than another country's paper promise. So when the headline screams that buyers are back and they are not done, it is accidentally telling you something truer than it knows. The buyers that matter are not back because they never went anywhere, and they are certainly not done because their reason for buying has nothing to do with this bounce, this quarter, or this Fed meeting. Their reason is structural. It is the same fiscal instinct that hollowed out that veteran's savings 3/4 of a century ago, only now it is playing out on the buying side. And this time, you can choose to stand on the same side of it as the government, instead of being the saver it quietly bleeds. And this is the exact spot where I have to stop and talk to you directly, because this is where a real decision sits. If you are a saver with $100,000 or more in a retirement account, a 401k, an IRA, the thing you spent a working life filling, then understand that you are standing in that war bond veteran's shoes right now. You are holding paper the system tells you is safe, denominated in a currency the government has every incentive to let quietly weaken so it can finance itself. That is not a conspiracy. It is arithmetic, and it already happened once. I put together a free retirement protection guide that walks through, in plain English, how some retirees are moving a portion of what they have saved into physical gold and silver, held inside the tax-advantaged retirement account they already own, without triggering taxes or penalties. Real metal that they hold, not another promise on a screen. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you go through it and want to talk it over, there is a free, no-obligation, one-on-one session for folks with $100,000 or more in any retirement account. Nothing to buy, just answers. Now let me get back to it, because we know who the real buyer is, and now I have to show you why they cannot stop. Here is the part that actually changes the whole picture, and almost nobody on the financial channels will walk you all the way into it. Ask yourself one question. Why now? Why are the central banks of the world stacking gold harder in this era than in any living memory? What is it that they see? Look at the debt. The United States is carrying a national debt closing in on $40 trillion and climbing. Run deficits like that, year after year, with no plan and no political will to stop, and you back yourself into the exact corner the government was in after the war. The interest bill alone becomes a monster. And there are only ever a handful of ways out of a hole that big. You can grow your way out, which nobody is doing. You can default, which a country that prints its own money never has to do outright. Or you can do the quiet thing, the thing that never gets a headline. You let the currency lose value over time, so the debt shrinks in real terms. And the people holding the paper, the savers, the bondholders, the responsible ones, pay for it without ever being told they were charged. That is the 1951 playbook, dusted off. And the central banks of the world have read it, because half of them have run it themselves. That is why they are buying gold. They are not chasing a bounce. They are getting out of the paper before the paper does what paper always does when a government needs it to. And that is why the real enemy here is not the market. It is the machine that keeps you staring at the wrong screen. Wall Street wants you trading the bounce. The financial media wants you glued to whether it was up 1% or down 1% this morning, because the tick is exciting and the truth is boring. And the Fed would very much prefer you keep your faith in the paper right up until the moment that faith quietly stops being warranted. They are all pointing your eyes at the fast little buyers so that you never look at the slow enormous one. And the slow enormous one is the entire story. Now I know that once you see this, a certain kind of number starts flying around, and I have to handle it with you honestly. There are voices out there, and some of them are not fringe. Some of them sit inside big banks, sketching gold at levels that sound insane from here. 5 figures an ounce, 10,000. Some go further, to 20,000, even 50,000. And I am not going to read those numbers to you as if they were a forecast you can take to the bank, because they are not. Where they come from is a specific piece of reasoning. The idea that if you ever had to back the dollar, or even partly back it, with the gold actually sitting in the vaults, the math forces the gold price up to a number like that. It is a monetary reset argument. It is a story about the end of the system as we know it, not about next year. The honest way to hold it is this. The direction those people are pointing, that a debased currency pushes hard assets higher over time, rhymes with everything the central banks are actually doing with their own money. But the precise number, and above all the date, is a fantasy nobody can hand you. The bigger the number, the more it is assumptions stacked on assumptions. Respect the direction. Distrust the decimal point. So let me bring this all the way back and answer the question you came here with, cleanly. Are the buyers back, and are they not done? Yes, but not for the reason the headline gives you. And if you believe it for the headline's reason, you will get hurt. The bounce is not the proof. A bounce is never the proof. It is just weather. The proof is who is standing underneath the price when the tourists leave. And underneath this price is the largest, most patient, most motivated buyer there is, buying for a reason that does not care what the Fed does this quarter or what gold did this morning. That is what separates a smart hold from a hopeful one. The hopeful holder is watching the bounce and praying it continues. The smart holder stopped watching the bounce a long time ago and started watching the buyer. Follow the buyer, and the noise stops matching. But I owe you the hard truth too, because anyone who skips it is selling you something. I cannot promise you a price, and I cannot promise you a date, and neither can anyone else, no matter how confident they sound. Gold can be volatile, and it just proved it. It got shaken, and then it bounced, and it can turn around and get shaken again just as fast, because in the short run the price answers to the Fed and the dollar and raw sentiment, not to the central banks buying quietly in the background. The official sector accumulating is a powerful current under the surface, but a current is not a schedule. Being right about the direction and being early can feel exactly the same for a long and painful time while you are the one holding. The debt is real, the buying is real, the fiscal instinct is real, but none of that guarantees a payoff on any timeline you get to choose. This is a case for why the setup is serious, not a promise that it pays off next month. On only what you own. Size it so that another shakeout can never force you to sell at the worst possible moment. So, what does a calm person actually do with this? Not advice, just how to think about your own position. First, own the metal, not the promise. The entire lesson of the war bond saver is the difference between holding a claim the system can quietly devalue and holding a real thing that is nobody else's liability. If you take one thing from this, take that one. Second, size it so a shakeout cannot break you. If a sharp drop would force you to sell to cover a bill, then your position is too big, no matter how right the thesis is. Because being forced to sell in the valley is exactly how right people still lose. And third, do not sell into the shakeout. The shakeout is the machine that moves metal from the people who react to the people who accumulate. When the price gets flushed and the headlines turn ugly, that is the official sector's favorite moment to buy. Do not hand them yours. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffreedguide.com. And the honest reason to look now is not fake urgency. I am not going to tell you the sky falls tomorrow. It is the opposite. The time to think a decision like this through calmly is exactly when nothing feels like an emergency, which is right now, while the bounce has bought you a quiet moment to think, and not the day everyone is panicking and it is already too late to think at all. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in a retirement account, and you mention that you watched this full video, You can claim a free, one-on-one, no-obligation educational web conference, a real conversation about what you actually own versus what you only think you own. That is for the folks at that level who made it all the way here, and you made it here. So could this video sit under any other title? No. You came to find out whether the buyers are really back and really not done, and now you have the honest answer, and it is a better one than the headline gave you. The buyers that matter never left. They are the biggest, slowest, most determined hands in the market, and they are buying for the same reason the government pinned that veterans' bonds 3/4 of a century ago. Because a state under strain always reaches for what it can trust to finance itself. The traders will come and go with every bounce and every scare. Ignore them. Watch the one buyer that does not flinch. That veteran holding his safe war bonds never got to see who was on the other side of his slow, quiet loss. You do. You know exactly who is buying, and you know why they are not done. The only question left is which side of that you want to be standing on.